YouTube, how are we all doing? I hope everybody is doing incredibly well. Really quite a big, interesting video today. It's basically going through my optimal setup. Now, I've been around, as most of you know, for over 10 years now in regards to my trading. And this is sort of my 9-stage step process for an optimal setup. And the first 8 stages, every single stage has to be met before I even entertain then, as you can see, the last 9th stage entry criteria in terms of executing the setup. So as you can see, this is a very strict plan. It's something you can take on board yourself, copy this from watching this video today, and start including it in your trading. I use it to this day, and like I said, every stage has to be ticked off. So let's get cracking into it. So to begin with, before I even entertain the actual pair, we're going to keep it simple. We're going to use GBP USD. We're going to use cable as the example throughout this video this morning. So corresponding index in this case will be the DXY, the Dixie as some of you may call it. So the DXY for me, before I even looked at cable GBP USD, the DXY I've got to see that weekly, daily, 4-hour are in sync. Okay. And I even check the monthly. I know what the monthly is doing all the time anyway, because obviously every candle on a monthly chart obviously just represents 1 month. So I know what's going on the whole time. I'm fully in sync with it. But it's worth just a check, especially if you're adopting this approach from after watching this video today. Pardon me. So corresponding index, the DXY, I have to see from a day and a swing trading perspective, I have to see that the weekly, daily, and 4-hour are all in sync, whether that's all bullish or all bearish. It doesn't matter. But for me, they have to be in sync, okay? If they're not, then I'm not touching it. And I'm waiting for the index, the DXY in this case, for that to happen. So let's just say 4-hour daily are both bearish, but the weekly is bullish. I am waiting until either the 4-hour and the daily change or the weekly changes, so they're all singing from the same hymn sheet. It's a thing for me. It works for me. It means I'm never trading against any form of, never trading against the trend, and I'm sticking as much probability and as much confidence in my favor. And as you know, trading is a game of probabilities. So after that, if they're all in sync, I will then go on to the corresponding pair, and obviously in this case that is GBP USD. I'm now looking to see, so if DXY is bullish on all higher timeframes, then I'm obviously looking to see if GBP USD is looking bearish because of the inverse correlation between the DXY and GBP USD. If we're seeing DXY strength, it means US dollar strength, hence sending GBP USD lower most of the time. Well, pretty much most of the time. There'll always be variance, but you know what I mean. A lot of the time it's incredibly brilliant. Now, with GBP USD, I'm then looking again, weekly, daily, 4-hour. Are we all in sync? So for this example I'm using, are they all bearish? Okay, if they're all bearish, brilliant. It allows me to then go on to my next stage. Now again, let's say weekly and daily are bearish, but the 4-hour is currently bullish because it's having a pullback on the 4-hour to allow the daily to pull back, which is healthy. That happens all the time. Then that's fine as well. But obviously before then looking at entries, I'm wanting to make sure that 1 and 4-hour are singing from the same hymn sheet as the daily and the weekly. So once we've gone through on the timeframes and multi-timeframes, that's then when we're concluding that sentiment, as you can see on the 4th point. Brilliant. So the DXY is bullish on all higher timeframes. GBP USD is bearish on all higher timeframes. Now I can start looking for an established area of interest, which is where we get into the nitty-gritty of where are we within price, where are we within bullish or bearish legs, and starting to establish an area of interest to look for a trade. Okay, so we've concluded that DXY is bullish on all higher timeframes, which means GBP USD, and we've concluded that that's bearish on all higher timeframes, so they are in sync. They're supporting each other, which is brilliant. Okay, so next we go on to establishing an area of interest. So for me personally, I'm looking to see, because on the daily and the 4-hour, you will see proper legs. You will see proper bearish legs, okay? But on the weekly sometimes, you'll just see it's melting, but you'll see wicks to the upside before the body closes lower, if that makes sense. So on the weekly, I don't mind if it's just melting, that's fine. But on the daily and the 4-hour, I want to be seeing nice swinging bearish structure, or bullish if it's a different example, but you get what I mean. I want to be seeing nice bearish swinging structure. So that would be obviously lower lows, lower highs, lower lows, lower highs, lower lows. Okay, that's on the 4-hour and the daily. Once we have established that, and if that is the case, if we're ranging, if it's choppy, if it's crappy, which is not a lot of the time because it's a higher time frame, so there's not a lot of noise, which is always good. But if that is happening, then again, I'm sitting on hands until it starts swinging nicely. But let's say again, we are swinging nicely bearishly. All we are simply looking to do here is obviously trading with the trend, we're bearish on GBP USD, and we are simply looking to execute shorts of confirmed lower highs, okay, so on the pullback of a bearish market structure. The reason for that is so your risk to reward is as good as possible. It allows us to get our stops. When I say tighter, they still need to be placed obviously in a way that if it gets hit, it invalidates the trend, of course, the higher time frame trend. But obviously, if we're getting a short off a big pullback, it gives us a better risk to reward in terms of that trade. Whereas if you're entering on quite a shallow pullback, you're not going to get a good risk to reward, and hence I'm not taking it. So establishing an area of interest, we're looking for multiple confluences. So if things like fib levels in terms of for me, it has to be a minimum of the 50%, 61.8 and the 78.6. Anywhere between the 61.8 and 78.6 of the fib for me is what I'm looking for, okay? Again, because of the risk to reward. There will be trades, don't get me wrong, where I'm taking trades off the 50% potentially because of other reasons, other conferences and so on. And a lot of the time on gold, from all the years of data I've done on gold, you'll typically find price will wick into the 61.8. This is only on higher time frames, of course, but price will wick into the 61.8, but typically body close around the 50% of the fib. Not all the time, of course, nothing's ever 100% in the markets, but a lot of the time I found that has worked absolutely brilliantly. And you've got to go away and do that work yourself, because every pair will react and move differently and have certain characteristics and display certain characteristics more often than not. So anyway, we're looking to establish that area of interest, as I was saying, of stacking all the confluences that I use for my strategy, and we start formulating an area of interest where ideally the 4-hour area of interest with the 4-hour confluences is similar to where the daily area of interest is with the daily confluences. And a lot of the time, again, if that's not merging up, then I'm not interested, okay? But a lot of the time it does with the way my strategy works, which again gives us even further confluence that brilliant. There's a high area of interest there because the daily, that's where most of the conferences are. The 4-hour, that's where most of the conferences are. So it's brilliant. Whereas if you've got 2 areas of interest miles off, again, it's a recipe for disaster. Sitting on hands and not interested. Okay, we move on to a different pair. But again, so let's say we've established that daily and 4-hour area of interest. All the time frames are singing from the same hymn sheet as we've already discussed, and all the conferences are aligning to that region. So we've stacked as many conferences in our favour. Notice how for me, conferences I'll only use conferences on the 4-hour, daily and weekly. I'm not interested in anything lower than that because quite frankly, conferences, breaks of structure, confirmations of structure and all the other things people might use, they are not as trustworthy on the 1 hour, 30 minute, 15 minute, 5 minute. The lower you go, the less trustworthy it is. The lower you go, the more noise there is. Now people might say, but I trade the 5 minute, but I use higher time frame bias. Brilliant, because you're not going to get caught out with the trend, but conferences, you're still going to take more losses, I guarantee. You're still going to take more losses because price action in terms of then getting your entry is still not as trustworthy on the lower timeframes compared to higher. So we've once we've got our area of interest, I've digressed there, so I apologise, but once we've got that area of interest, we are then looking to make sure, can we get a good enough risk to reward from this potential area of interest in terms of entry? The stop loss for me is always placed in a way where if the stop gets hit, it means I'm wrong, it means the trend has changed, and so be it. That's good, because I want to be taken out if that's the case. Otherwise, it's going to keep going, it's going to reverse against me and keep going against me. So stop losses are there for a reason, guys. They're not a bad thing, but if you place them correctly, know how to place them correctly, it will take you out for the right reasons, and it's a good thing. I promise it's a good thing. Don't see them as a bad thing. They're only a bad thing if you're putting them willy-nilly or you're using the same amount of pips for every trade for the stop loss. It doesn't work like that, and if you're doing that, you're doing something massively wrong. So have I got a good enough stop loss in place that allows me to cover price structure and so on? If so, then the way I work my targets, that's for another video, but the way I work my targets, does that allow me at least a risk to reward of a 1% loss to a 3% gain? Now, a lot of my trades, it'll be a minimum 3% target, minimum. in terms of, so my probability and edge over time continues to play out. But typically it's anywhere between 3%, 3.5%, 3.25%, 4%, something like that. Okay, and if that's the case, brilliant, we are good to go. Because I then have my stop loss placed, it tells me the number of pips that stop loss is. That allows me to then put it into my calculator to work out the desired lot size for the trade. So again, it equates to 1% if my tailored stop loss gets hit. And once that's the case, we are simply then sitting on hands, waiting on hands to see when price, if it gets to our area of interest, is it showing my entry signs and criteria? Multiple wicking, slowing of momentum. Are we seeing things start to range, start to consolidate, starting to have a rest phase? All these criteria that I'm looking for. Now, entry criteria for me, I'm looking at the 1 hour typically. I'm looking at 1 hour body closes. I'm looking at 4 hour body closes, okay? I do not give a crap about anything lower than that. Now, if I'm scaling into trades, which is a different video, then fair enough. I might pop down to the 30-minute. But again, that's probably as low as I typically go. Because again, from a trustworthy perspectiveness. So I'm looking for multiple bodies, multiple wicking and exhaustion to around my area of interest, which shows that we're being respected. Okay? And if that is the case, then I'll look to take that entry. Okay? So guys, I hope that helps. Again, I don't like rambling on. I want to keep this information as concise as possible. But in a nutshell, those are the steps I look for. Now, this video would end up being triple the size of this if I go into these segments too much in terms of the confidence I look for and so on. But if you're interested in learning more, then check out the links below. But other than that, guys, take this framework, use it for your trades, and let me know how you get on, because it works incredibly well for me. Yeah, I wish you all the best with it. Okay, and any questions, as always, pop them below in the comments. Take care, guys, and I'll see you